apologize, but all right. So, chapter 1, guys, general introduction. Again, easier to read than after the fact as you go through the material. Chapter 2, contributions of property, formation of a partnership, generally tax-free, right? Code section 721, and then in addition, there's code section 722, 723, and then we just learned last class code section 724, right? Code section 724. And code section 724 preserves the character of the gain. Sophia, can you come down? They cannot hear me. Okay? And it's recording, so just be careful not to exit out, but they cannot hear me. Okay? Thank you. So everyone got that? Code section 721, 722, 723, 724 preserves the character when in the hands of the partnership, right? For inventory and capital losses, right? And then keep in mind holding periods, code section 1223.1 and 1223.2. All right? So you also got the first taste, but we're going to have an affirmation of your taste in what is liabilities. What are liabilities under code section 752, right? What are liabilities under 752? Why is it being introduced? Chapter 2, because people contribute property, right? Subject to liabilities. And if you can bring out the red pen, metaphorically, you want to know the difference between recourse and non-recourse liabilities, right? So we went through that, but good news, if you were feeling a little lost in that, we're going to go through a lot more examples today. All right, so we made it through that, and then we formed the partnership, code section 709, dealing with expenses, and it's just stuff you've seen before, code sections 195 and 248. Chapter 3, operations. We go through and we know that partnerships, the outside basis is fluid, code section 705. We know that certain items have to be separately stated. That's affirmed in Schedule K1, right? All those separately stated items. And we went through chapter 3. We saw that the assignment of income doctrine takes a back seat. Everyone can figure out the tax year of partners, right? The tax years of partners, very mechanical. We look towards the end of chapter 3 at code section 199A, which is, for now, at least until it's repealed, an important code section for many taxpayers. Towards the very end, we talked about the limitation on losses, and we know those limitations come in 4 flavors: basis, at risk, passive, and the new law, which is memorialized in 461L. They're good? All right, so Sophia, what was the magic wand that you touched? The mic straw? Yeah, how did that happen? Okay. Thank you, Sophia. Sorry about the mad rush. But there's a lot of people up there very appreciative of your efforts. I'll thank you on their behalf. All right, so everyone's got that losses we know must be realized, recognized, and allowed, but we know that there are these several disallowance provisions, and everyone's antenna always goes up with respect to losses. Then we turn our attention to chapter 4. And chapter 4 deals with allocations. And again, when it comes to partnerships, allocations are key. They are what makes partnerships what they are. Now in theory, when it comes to partnerships, some people are under illusion you can do whatever you want, right? But not you, right? Because you know better. You know one of the keys here, EK, is what? Ben? Because in the partnership class, you must see.
Substantial economic effect.
See. You must see, George, as in S-E-E.
Substantial economic
Come on,
effect.
guys. Don't you have your mnemonic devices? No hesitation, George. Substantial economic effect.
I don't remember it.
Okay?
I'm sorry. Remember the phrase.
All right, but you got to get all this stuff right? Because at the water cooler, George, if you want to sound cool, okay, you got to be able to say substantial economic effect.
Professor
Right.
Solid, I think you might need to mute one person there. Yun Hong or
It
Hui?
sounds like I like to mute a few people,
Yeah.
but I don't know if I can.
Yeah,
I can.
that person, yeah.
Look at the power I have. I what was that? All right, good. All right, so substantial economic effect, guys. We got that down. We know that there is the main test of substantial economic effect, and we know there is an alternative test, right? Where if you don't have substantial economic effect, but you have a qualified income offset, that too will work. What's key here? What's key is that you must maintain capital accounts, right? Because if you do get these special allocations, Jacqueline, right, they've got to be reflected in the capital accounts, right? That was supposed to be an emphatic right. All right, that's what I want to hear. All right? We talked about what's economic effect, reflecting that in each of the capital accounts. And we talked about the alternate test, qualified income offset. You fail those tests, you're back to the partner's interest in the partnership, right? The partner's interest in the partnership. We talked about what does the word substantial mean? It can mean shifting or transitory allocations, where if taxpayers are playing games where only for tax purposes, one taxpayer is doing better from a tax perspective and no taxpayer is doing worse, that suggests that it may fail the substantiality test. All right? So we talked about that, and again, this is key. Okay? Then we talked last class about allocations pertaining to non-recourse debt. And they pointed out, or the authors pointed out to you, that such allocations can never, ever have substantial economic effect, right? Cannot have substantial economic effect. So when you hear about these allocations, what is the sine qua non that you need, Corey? Isabel? Not sure? Simi, what do you need? What do you need if you have non-recourse debt, Chrissy, in your partnership agreement? Ron?
Minimum charge, minimum gain.
Minimum gain chargeback, right? You need your minimum gain chargeback, right? Because if you don't, in other words, even though these allocations, right, Shannon, won't have substantial economic effect, as long as you have that minimum gain chargeback, once you make that allocation, that person's on notice that subsequently they may have to pick up the taxable income, right? And pick up that Tufts-like gain. So you can allocate, and the capital accounts can go negative. Does tax basis go negative? No, right? Tax basis will never go negative. But capital accounts can go negative even if the person has no deficit restoration, as long as there's a minimum gain chargeback. Right? So just keep that in mind, that you can allocate these deductions to partners, even though it lacks substantial economic effect. Don't worry about targeted allocations. We moved on to Chapter 5. And we talked about, and notice, Chapter 5, the title of Chapter 5. It's entitled Partnership Allocation. Sound familiar? Right? Sounds like, gee, been there, done that. All we need is substantial economic effect, or meet one of the tests, or have minimum gain chargeback, and we're good to go. Not true. Okay, not true. That special rules are going to apply with respect to, well, in the first case we're going to discuss, and we have discussed, with respect to contributed property, right? Congress is nervous that people are going to have, with respect to contributed property, that they may shift income, right? And you guys, most of you, not all of you, know about the famous Lucas v. Earl and the fruit and the tree metaphor, right? And if I grow apples on my tree, I cannot just give that apple, right? Cannot just give that apple to Alvin and let him be taxed on it. So it's got to remain taxable on all the apples grown, right, Alvin, on my tree? So similarly, partnerships might be an ideal opportunity to take the apples on my tree, contribute the tree to the partnership, right? And spread the apples among, my partners, right? Nope. That's not what Code Section 704C permits. All right, I know what you're thinking. I'm pushing the tree, the apple and the tree metaphor a little too far, but can't hurt, right? Everyone agree? You grow the apples, you get taxed in the apples. You can't contribute it to a partnership and run Lucas v. Earl. Agreed? All right. And that's contributions of property. If you remember the case we looked at, where usually if you contribute your services, the assignment of income takes a back seat. But with respect to contributed property, not services, not true. Code Section 704C. Okay? So, we looked at 704C and we saw that there's several methods to handle contributed property. The traditional method with curative allocations, and then the so-called remedial method. And beginning on page 174, we looked at, or the authors walk us through, the application of these three methods with respect to both tax and book. And I encouraged you to read this on your own, that these authors, you don't get to be in the 9th edition based on, nothing. This is, again, people know, with textbooks, I generally think, hey, if something is in a later edition and it's very popular, there's a reason for it. And in this case, this is, just like the income tax book, the most widely used graduate tax partnership tax book. And there's a reason for it, is that it's fairly straightforward. Partnership by tax, as you guys I think are well aware of, is not the easiest topic in the world. So there's no case book. Don't think there must be some simplified case book that makes this all very easy. That book does not exist, guys. So
You gotta mute her again. Somehow she got unmuted.
who is the unmuted?
However you say that. I think it's Yun Hong. Okay, there you go.
Someone's having a good time. I don't know if it's all tax related. All right, so we talked about both the sale of contributed property, the character if that property is sold, 724, and the depreciation of that property. We held off doing one of the problems that illustrates the depreciation, which we're going to cover right now. But that's the essence of this material, okay, is to look at contributed property and look at what happens if it's sold and how it's depreciated. So that brings us up to where I believe we left off, on page 188. We didn't do the second problem. Our job tonight, guys, is to finish this chapter, and time permitting, which I hope it will, and we'll finish chapter 6 and get into a portion in chapter 7. If things fall perfectly into place, our goal line for next week is to finish chapter 7, okay? And that's what would get us right to the midterm. All right, so the goal line would be, George, to finish chapter 7.
Then we're going to be up to chapter what? 7?
7. All right, so in terms of the material you got to master, it's going to be a lot.
And for exam after 2 weeks from now?
2 weeks from today. All right, mark your calendars. And George, what's on your calendar for October 26th?
Yeah.
All right, not the, well, I'm going to mispronounce it. V, help me out.
Diwali.
Diwali, not Diwali. The tax Sunday's Diwali. Okay, so we'll have a different festival of lights here on the 26th. And can I mention? We're having 3 speakers. 2 of the 3 are speaking on partnership tax issues. How's that? So I could sway the agenda. I swayed the agenda, guys. Who knows? Maybe there'll be a final exam question on something they raised during. Who am I to say? All right. So consider coming that Saturday. Okay. Consider coming that Saturday. You know, some of the people on WebEx are saying, "Can we do that? Can we do that Saturday night event by WebEx?" No, physical presence, guys. Right? There's some things in life you got to be physically present for. All right. What was that, Kevin?
I said it used to be for taxes as well, but not so much anymore.
Well, all right. Any questions on the material? We're all good? All right. So let's get into the new stuff. All right. And I'm going to.
What is the question format?
What was that?
The format of the question?
The format. I'm not sure exactly, but I'm sure it'll be a combination of true, false, multiple choice, short answer. Think just like many of the problems that we've seen. Okay. Okay. So, all right. So I'm going to cover question 2. Question 1, just to remind people, with the sale or disposition of property. Everyone can handle that, keeping in mind that with the, remember, you're keeping tax accounts and book accounts. And the notion from the takeaway from problem 1 is, to the extent possible, to give the non-contributing partner, whatever book gain or book loss they should be entitled to in terms of tax, right? In other words, when we did our computations, if you pull out problem 1, is the non-contributing partner should have whatever the book consequences are. And we're going to see that somewhat same sort of philosophy extends with respect to depreciation. Non-contributing partner should get, again, the appropriate gain and loss, and whatever remains goes to the contributing partner, okay? So bearing that in mind, guys, A contributes $100,000 of cash to the AB partnership, and B contributes a building with an adjusted basis of 50 and fair market value of 100, okay? Economically, are they 50-50? Hell yeah, right? They're each contributing $100,000 worth of property. So just make sure when you're dealing with your clients, my experience, guys, when people rely on you as accountants, my experience is many times they look at you beyond just accounting. They want to know, are they getting a good deal? Now be careful. You don't want to be like their business partner, because you know and I know you ain't going to get the upside to that. But if there's a downside and you act as their business partner, they may blame you. If you say, oh, this looks like a great deal, yeah, put your money towards it. But if there's a reason not to, because you think they're getting the short end, you may want to warn them, and then let them make their choices. But be careful. That's a delicate line. All right. If the building is depreciable, has a 10-year, I circled the word 10-year because you'll see why. Just to remind people, it's a 10-year remaining life. It's depreciated using straight line method. How much tax and book depreciation will be allocated to each part? Okay? So I'm assuming everyone here has, so we're going to do problem 2A. And we have A and B. And they have tax and book. And remember, B contributed property, A contributed cash, right? Okay? And the building itself, there's 10 years remaining. So it's $10,000 a year book depreciation. So how would you allocate the book? Because first you're going to allocate the book, right, guys?
Equally.
Say again, Viva?
Equally, yeah.
Equally. How much each? 5-5, right? Okay? And how are we going to allocate the tax depreciation of 5,000? Goes to B, right? The non-contributing partner, right, guys? The non-contributing partner. This is found in, this is under 704-3B. Go ahead. Go to B. Oh, excuse me, A. I'm writing A. Just go to A, the non-contributing partner. B contributed, B gets 0 depreciation. And if you keep playing this out for the next 10 years, you're going to see that it would end up being where A and B would have 50, 50, 50, 50, right? At the end of the day, right? If you keep playing it out for the next 9 years. So the non-contributing partner in this case, A, says, gee, I deserve to get $5,000 depreciation, and that's only if you, B, if you had contributed property with a $100,000 fair market value, or excuse me, with a $100,000 basis, I would have gotten that depreciation. So that's fair, right? Suppose in this case, same as A, except that B's basis in the building is $60,000. So in that case, the tax depreciation is going to be 6, right? Are we going to allocate the book depreciation, guys?
Equally.
Equally, right? Because they're 50-50 partners. Are we going to allocate the 6,000, V?
5 and 1.
Okay. 5 to the non-contributing. Look at the balance. You know what? You're absolutely right. I'm thinking to myself, we gotta get it all back to 50. My apologies, thank you. You can't even invoke the after 8 o'clock rule. My brain was saying it, but I didn't let that go. Okay, it starts off at 60. Okay, everybody agree? Because after 10 years, once again, we'll have 50. 50, 50, 50, 50. Everyone agree?
Just a question. Why not all the 6 for 50?
What was that?
Why not allocate the $6,000 depreciation entirely for 50?
Because A shouldn't get more than the book depreciation. You should never get more than you should economically.
Okay, that's 50,000 exactly.
Yeah. Okay, question C. Now if the use basis in the building is 40,000. And yes, I'll try to get it right this time. Instead of putting 60 or 50, I'll put 40. I think that will be a good start. Okay, are we going to allocate the book depreciation? You guys are on a roll.
5, 5.
Okay. Okay.
And then
Yeah.
5 and plus 1, minimum gain.
What, babe?
I mean, there's a gain, right? A
Where's
still
the
gets
gain?
5.
Oh, it's depreciating.
Right, but A still gets 5 and then B.
All right. They can't get 5. There's only 4,000 in depreciation.
Oh, sorry. So A gets all 4.
A gets all 4. This is the ceiling rule, right, guys? A's not a happy camper, right? But A gets all 4. Everyone see this is reflective, right? Of the ceiling rule. And for your notes, the ceiling rule you can see in one of the examples. You'll see it in your textbook, but 704-3B2, example 1, 2 little i's. I'll repeat. 704-3B2, example 1, 2 little i's. Anna, can this be fixed? I'll help you. Is there a cure for this?
Yeah, give A another 1,000. Oh, contribution, yes.
David, say again?
He can contribute 10,000.
Or
That
1,000.
doesn't have to help for depreciation purposes, guys.
One. So then you give A 5.
Look, let me just for your notes, and then we'll get more. You can do a traditional method with curative allocations, Anna, right? That's my hint with the word cure, right? And when the partnership has some losses, ordinary losses, those can be allocated to A, the ordinary loss, and a corresponding income to B, right? And then we're going to talk about a remedial allocation. We're going to look at it in a few minutes, okay? Remedial. So there's 2 different methods to cure the ceiling rule. See?
So why can't we just give A 5 and then.
You can't. It's not, guys, just so you know, what we talked about last week with respect to a sale, you can just pull numbers out of the thin air. You can't do that with depreciation. You'll see an example when we go through depreciation.
Even if you give B like 1K gain?
Let me just,
Okay.
I don't know if someone had some questions, but I can't see what those questions are. I apologize. Go ahead, B.
So if you made A's depreciation 5, couldn't you just give B a $1,000 gain?
No, you can't. You don't mean the
Okay.
gain, you mean 1,000 of income. No,
Income,
you
yes,
can't.
sorry, yeah.
You can't. You're not allowed. If this was the sale of property, you could. but that you can't do with depreciation deductions.
Okay.
Okay? So everyone understand, with the sale of property, which we covered last class and we covered in problem 1, when it came to the remedial method, we could pluck numbers out, and as long as there was the yin and yang of symmetry, it worked. With depreciation, you are not afforded that luxury of pulling numbers out. Okay? Right, Angie? Okay. So, again, A, B, and C, guys, are just fun, illustrative rules. Because when I say that, many accountants and lawyers never see this, right? They just allocate, oh, they're 50-50 partners, we'll just allocate depreciation evenly, right? And they don't realize that 704C principles do not permit that. And, you know, remember, you gotta be careful here, because if you're the accountant and you just give each one 50% of the depreciation, your client A, right, because you represent, and here's potential conflict of interest, your client A is not gonna be a happy camper, right? Because they should have gotten more upfront depreciation deductions possible. In question D, now we're going to turn it around. B contributed a building with $120,000. So now the depreciation is 12, right? So we're back to Patrick, you see I'm keeping that 120 right there. Thank you. Keep me in check. Just want to make sure. I have another sip of my cold brew coffee here. So, how are we going to allocate that book depreciation, guys?
12 to B.
Hold on. Book.
Oh, sorry, equally. 6 and 6.
Why do you say 6 and 6?
Because it's 12 in total.
No, that's tax. The book has remained at 10, right?
Oh, sorry, yes.
You need some cold brew too.
Yes, I do.
All right, 5 and 5, guys, right? Notice, kind of boring, the book depreciation, right? Everyone gets 50%, right? What about the tax depreciation? How are we going to allocate that $12,000 annually?
To B.
Say again, Dave?
The first year to, well, no, let's give A 5 and 7 to B. How about that?
And would you say that is correct, Ken?
My answer is also this way.
Your answer is also what?
This way.
Same as Steve's.
Same. Yes.
Chrissy, you agree? Yeah. We give the non-contributing partner what he or she deserves, right? Everything else goes to the contributing partner, right? Everyone agree? Chisholm, do you agree? All right. No one's going to be mad if we do a depreciation problem on the midterm? Everyone can handle this.
Can the entire midterm be on this?
I don't know if you want that, but. All right. If an A, okay, back to A. If the building is sold for $90,000 after it's held and depreciated by the partnership for 2 years, how must the partnership allocate the tax gain on the sale? So after 2 years, okay, think about it. I'm going to take out my trusty dusty eraser here. Guys, figure it out. Try to come up with a number. Don't just sit there. Got to figure out what your tax basis is for tax purposes and then for book purposes. Everyone have some numbers? All right, Patrick, now it's my turn to ask you, what did you get for the tax gain and book gain?
Looking extra.
Tax gain?
50.
Profit, agreed?
Oh, 50.
The loss, Michael? Book gain 10? The Kuzwa? Say loudly. Say 40. Alan? Say loud, softly. The loss? Fine, guys, let's break this down. Pretend it isn't partnership tax for the moment, which is hard to do. For book purposes, what was the value of the building going in?
100.
It was 100,000, right? That's what the book value was 100,000. And just so you guys, I apologize. You say, hey, so can you keep it consistent with tax on the left, book on the right? Okay, I hear you. All right, so fair. All right. So for book purposes, it was 100. Tax purposes, we start off with 50, right? And if you recall, how much book depreciation do we get each year?
10.
Okay. That's 80, right? And tax depreciation each year?
0. Oh,
5
Sorry.
each year.
yeah, I'm thinking about B.
So right now, that would be our adjusted basis, code section 1016. Everyone agree? So that's what it's worth on the books, 80,000 for tax purposes. Kuzwa, 40, right? Is our adjusted basis. And we sell it for 90, right? So we sell it for 90, right, Patrick? It's 90 is code section 1001. We sell it for 90. Our adjusted basis is 40. Tax gain of 50 for book purposes. For book purposes, we're selling it for 90. We've experienced a $10 gain for book purposes, right? All right. So now that we got that, everyone sees that. Now let's do A and B. We have tax and book. You guys have been there. You remember? 100, right? Cash contributions, 50, 100. Okay? We took depreciation for 2 years. Took, 10,000, well, 10,000 each, right? Total 20, right? 5,000 each year for book purposes. And taxpayer A is going to demand how much tax depreciation? 5 each year. And A is going to demand all 10 of that, right? So for tax purposes, I shouldn't have put a line here. It gets all 10 depreciation. Now, what was the book gain, guys?
10.
The book gain was 10, right? Book gain was 10. How does that get split?
Equal.
Even, right? They've agreed to share profits equally, right? Who gets the tax gain?
B.
How much is our tax gain? 50, right?
Well, A gets 10.
A gets 10.
Shouldn't A get
Hold
10?
on, hold on. How much does A get? Don't we give the non-contributing partner, who's the non-contributing partner here? A. Don't we give the non-contributing partner 5?
5, okay.
Everyone agree? Give the non-contributing partner what he or she bargained for, right? They should be saddled with 5. And what does that mean for B?
45.
45.
Professor, I'm sorry, why are we not allocating the entire 50?
What?
Why aren't we allocating the entire 50 to B?
Why aren't we?
Isn't this the traditional method that we are doing?
This is the traditional method.
And so we are not allocating 50 to B.
We don't need the ceiling rule. There's no ceiling rule here. So I'm not sure what your question is.
So I thought because
Don't you feel it's appropriate for B to get saddled with the larger gain? It can be this property with a large embedded gain.
but because he contributed properly with the built-in gain or appreciated property, wouldn't the entire gain first be allocated to 50,000 to head to B?
Well, that's not how it does it. First, you look at economically what the partners should get. Give the non-contributing partner whatever the gain or loss should be, and the balance will go to the contributing partner. That's just what the regulations instruct. All right? Suppose the building is sold for $60,000. Suppose the building is sold for $60,000. Now, do the same thing. Is there a tax gain or book gain? Come up with numbers again, guys. Oh, Elizabeth, any gain or loss? Tax gain or loss. Trent? Any tax gain or loss, Trent? Say it again. Gain for tax? 20, right? Amount realized 60 basis of 40, right? And kit for book? Loss of 20. Everyone agree? So everyone on the page, we have a tax gain, right, of 60 minus 40. And here, 60, our book value is 80. We have a loss here of 20, right? Everyone with me on that? Because I'm gonna switch the screen. And we're gonna go back to A and B. And we're gonna have tax book. And how much was we knew the depreciation stayed the same, right? Then we had our book loss. How does that book loss get allocated? Equally, 10-10, right? Everyone agree? And our tax gain is going to be allocated to Tom. Who? Sandra, see if you agree. Tom, who would you allocate it to? Say again? To B? Andrew, agree or disagree? I'm sorry? You're thinking A. Angel, who'd be right? Just say it loudly. You would allocate it to A. Why? Guys, can you role play a little bit? Can you role play? Can everyone role play here? Who do you want to? Sandra, you want to be A or B? Tom, you want to be B? Okay, so Sandra's A, Tom is B. Sandra, do you want? There's 20,000 in tax gain. Do you want any of that? Not only would you say no, you would say, hell no. I suffered economically. Look, I got a $10,000 loss in this property. I am not a happy camper. Excuse me, Tom. You're not going to saddle me with this gain. We only have this gain, Tom, because you contribute this property. You're supposed to role play and start yelling at him, Sandra. Yeah, Tom. So what are we going to do to Tom?
Give it all back.
Give it all to him. Tom, you're not such a happy camper because you're now going to be saddled with $20 worth of, maybe $12.50 unrecaptured gain or whatever. I don't know what they depreciated here, but the tax gain here is all going to be allocated 20 to you. All right, and that's life. But this is the application of the ceiling rule, right? Because we can't give, in this case, we can't give Sandra what she really economically should have gotten in terms of a loss. So it is what it is. And we cannot pull numbers out of thin air. We're going to see in the next problem. Yes, Kevin.
Didn't I get the reflection where I can't begin for what you
We can't. We're going to see that the rules don't permit it. Let's look at the next problem, and we'll see if you decide G. We want it to be fairer. Let's do problem G. Okay. Okay. In this case, what results in C above if the recovery period of the building, keep in mind, is 20 years. Okay, so a building we're going to presume has a total recovery period of 20 years. The partnership elects the remedial method of allocation. Now, see if you can come up with numbers here so that now the remedial method is spelled out in Regulation 704-3D2. I'll repeat, 704-3D2. And does anyone recall what you're required to do with respect to the remedial method? B, you're nodding. What do you do?
Well, you give A what he deserves.
But how do you do it? That's verbally we agree. Give A what A deserves.
So we pluck numbers out of the air.
But we can't. That's the
Well-
thing. What we're required to do under the regulations is to create two assets. Two assets. The first asset is considered asset one with a basis of $40,000. It's equal to whatever the current adjusted basis is. So asset one is equal to 40,000. Asset two is equal to 60,000. Okay, so here's what the regulations tell you to do. You'll see it works. So if you're thinking to yourself, remember with the remedial method, it allows luxury, so we're creating an asset out of thin air. Okay, asset one with a basis of 40,000, and asset two with a basis of 60,000.
So you're just splitting it. You're splitting the book value.
We're
of-
splitting the book value between the remaining basis and we're creating a new one. So asset one, asset two, no, the first asset, you depreciate over the remaining lifespan, which is 10 years. Everyone see that at the bottom of the page, at the bottom of page 188, there is 10 years left to run. Asset two, which is deemed to be 60,000, has 20 years. That would create $3,000 in depreciation. So you create two assets. One asset you use the remaining lifespan. The second asset you depreciate over the entirety. Okay? What's the total depreciation? Everyone here can handle that math. $7,000, right? Now, that's $7,000, guys, of depreciation, and you're going to see, obviously this is somewhat artificial. Watch what happens. Depreciation from years 1 to 10 for the next 10 years is going to be, how much is the book depreciation? $35,000 each year. I mean, it's $3,500, right? But over 10 years, $35,000. Where did that number come from? 7,000 divided by 2, okay? Because they're splitting deductions 50-50, okay? That's $3,500 each, right? Over 10 years, guys, right? Over 10 years, that's $35,000. Agreed? That's just over 10 years, depreciation over 10 years. Okay? In that instance, what do you think the non-contributing partner should get there? A, how much depreciation deduction should the non-contributing partner get?
3.5.
3.5 or a total of 35,000, right? Because, right, we want to get the non-contributing partner what the non-contributing partner deserves, right? Because now Sandra will be happy. Sandra, you happier? You got what you bargained for, right? You got the right amount of depreciation deductions, right? How much tax depreciation is left? If Sandra gets $3,500 each year, how much is the real depreciation each year? Isn't it really $4,000 per year, guys? Isn't? If you look at the real depreciation, right? We had an asset from problem C with a basis of 40,000 with 10 years to run, right? So if Sandra's getting 3,500, how much should Tom get each year? 500, right? And over 10 years, $5,000 with the deduction, right? What happens through the next 20 years? Depreciation, years 11 through 20. Well, what's going to happen now? Asset 1 is depleted, right? Asset 1 doesn't exist anymore, right? Only asset 2 is left. And asset 2 is how much depreciation each year, guys?
we in between. The remaining 5 times.
It's $3,000, right? Divided in half. Right? 1,500 per year, right? Okay. Now, people appreciate this. Is there any more tax depreciation left, guys? Is there any more tax depreciation left? There is none, right? Because this asset, for tax purposes, has been totally exhausted. Agreed? So, during the second half, Sandra, as taxpayer A, still wants her deduction, and she can. She can get her $1,500 per year. I'm trying to see who am I.
You're not.
I think we just did that right? So we just pulled this number, right? $1,500 per year out of thin air, right? Because we want to give the non-contributing partner what they deserve. Okay? And what do we do for symmetry? Every year we're going to give Tom, or the contributing taxpayer, $1,500. All right? So that's where the remedial method permits you to just create numbers.
So he gets the gain.
You're right. I apologize. This is a deduction, right? That's a deduction, and we're going to give a corresponding income. Okay? Oh, thank you. So what ends up happening when you do it, this will end up being 50, 50, 50, 50. And life is good. Life is real good, right? So the point is, with respect to the remedial method, when you sell property, you can pluck numbers to create symmetry out of thin air. That's problem one. If you go back to your notes, with the remedial method, we pulled numbers out of thin air. With respect to depreciation, you're not afforded that luxury. You got to create these two different assets. Depreciate the first asset over the remaining term. The second asset, you have to depreciate over the entire lifespan of the property in question.
So asset one will always have the same value as the tax value of that asset.
Yes, well, the adjusted basis.
Right. Yeah, okay.
Okay, and whatever is left up to the fair market value will be the asset too.
So the moral of the story is never accept property from a partner.
Well, if you get the right property. Tom was giving, sorry Tom, there's a little bit of a booby trap property here. All right? And then you just have to ask clients what they want to do, because you got to be careful as the accountant, because depending, if you tell them, oh, you should go in the remedial method, Tom may not be as happy as if you just went with the traditional method. Because under the traditional method, Tom doesn't have to deal with this for quite some time down the road, where with the remedial method, he has more, the consequences are more front-loaded. So it really puts you in a quandary about who you represent and all sorts of ethical issues here. Lark. All right? Be careful what you ask for. B said, oh, I like lots of these problems, but you may not want to see too many of these problems, right? But these are just in the regulations, guys. This is not, the authors were not being creative with this. This was just in the regulations, okay? All right. Page 190. Deals with partnership interest acquired by gift, purchased from a family member. keep in mind, remember, partnerships can be used potentially as an occasion to get wealth tax-free to family members, right? And theoretically, under chapters 11 of the code, that's code section 2001, we have an estate tax. Under chapter 12 of the Internal Revenue Code, beginning at code section 2501, we have a gift tax. Beginning chapter 13 of the code, code section 2601, we have a so-called generation skipping transfer tax. Okay, theoretically, these three taxes are supposed to be the bulwark of trying to have a tax theoretically once every generation. I don't want to get into it, but it applies now currently to 0.1% of the US population. So query whether or not it's truly doing its duty. But Congress also, aside from having this tax system, this transfer tax system, we know under Code Section 1 that there's a progressive rate structure. And the highest rate currently is 37%, right? And it's a graduated rate. So just like Lucas Fierro, assignment of income, fruit of the tree, is that people could try to assign income to their children, right? Now be careful with minor children. Unearned income is currently taxed at what rate? For not their parents, the kiddie tax is no longer. It's taxed at the trust and estate tax rate, which is essentially the flat rate, highest rate. So under the 2017 Tax Act, the kiddie tax was done away with, and now there's a much higher tax rate. I'm trying to write a new paper. Are there any people here, and I am not, but I could use, if someone wants to, you can email me offline. Any gamers in this room? Does anyone play video games for money here? No one? Well, if you do, but you don't want to say so, send me an email, because I understand, and you guys can correct me if I'm wrong, that there are whole stadiums now being built
Yeah.
around people who game. And what you do when you go to the stadium is you watch people game. Is that true?
What's that? The biggest game that everyone's playing?
Fortnite?
Yes, Fortnite. Yes. Oh my
Is
God.
it like Fortrain or Fortnite?
The winner won, I don't know how many, an obscene number of, I don't know, some $1 million. 16? That's obscene just for winning Fortnite.
All right. Anyway, we're making some progress on this paper about some tax issues regarding gaming. We're trying to be the first kids on the block to write about this. Say again, David? 0. But doesn't mean I can't write the tax effects, right, David? I will share with you. I think I alluded to this. One piece of good news, but we'll see. Even if it never makes the public domain, I'll share it with you in the weeks to come once it's I get it in shape. I spent an hour on the phone yesterday with whom? And I think I suggested that I was going to do this. Is Mark Everson? Do you guys remember that name? He was commissioner of the Internal Revenue Service from 2003 to 2007, and we have an op-ed that when it gets really good, I think it's pretty good now. When it gets really good, we'll try to get it published, and even if it never gets published, I'll share it with you. So he was a very nice guy, and the good thing about it is he toned me down. If you guys have ever seen my writing style, I try to make it, how do I say, energetic. So I have to be toned down a little bit. And he said to me, look, I'm a former commissioner. You cannot use adjectives like this, and my adjectives sometimes can be a little over the top. So
Tell us what adjectives you used.
I used some, that this was a dystopia. And he said, you can't use dystopia. If those, what a dystopia is, some people are laughing, but they don't know what dystopia is.
It's the opposite of utopia.
It's the opposite of utopia. So if you don't live in a utopia, some people think we live in a dystopia. All right, so there's some phraseology. I can be a little bit over the top. So he toned me down. The title of the piece I would have had is, "The IRS Needs Technical Dominance." Okay? He said, no, the IRS needs technical parity. Okay? So, he just toned me down. You guys, again, remind me if I don't tell you in a few weeks. I will gladly send you around a copy. All right. So, page 190, I told you the purpose. Code section, let me just point out this Culbertson case on page 190, the second full paragraph towards footnote 94. Everyone see that? This towards the end of the second paragraph. It says the court discussed the issue again and re-delivered its message, holding that the ultimate question was whether, after considering the facts and circumstances, the parties in good faith had a bona fide intent to join together and conduct a business as partners. So, is this truly going to be used to conduct business, or is this just a methodology to pass wealth to a younger generation, right? So, that's a case that sets a standard. If you look at code section 704E, so why is this even here, you might say? Okay, good question. Keep in mind, guys, what are we looking at? People sometimes think special allocations, you can do as you please, right? Everyone agree? People harbor that notion. And we know that's not true because George is going to say we need to see, right? You need C. And George, that stands for what, quickly? Come on, George, it's got to leave your lip. Is that substantial economic effect? Practice, not here. Tonight in the mirror. Substantial economic effect, okay? Everyone's got that? But, we just saw with contributed property, are you given carte blanche? You're not even given carte blanche. You need C, right? Or you need to meet the qualified income offset. You need a minimum gain chargeback. And we saw that with respect to contributed property, if it's sold or depreciated, can you do as you please? No, you saw all the equations. Well, code section 704E says in the family context, we're even going to be more circumspect. You're not going to be able to just do special allocations. So we're going to see this in action. If you look at code section 704E, it puts the brakes on forms of special allocations. Okay? So let's just go right to the jugular here. Page 192 of games taxpayers will play. Consider whether the following situations will be respected as a partnership under the Culbertson standard. That's, is this truly legitimate or not? Father is a lawyer who makes son a contractor and a daughter a student, partners in his law practice. Something smell in Denmark, guys? And you know it does. And I'm not even sure if this is legal, right? A law office cannot make non-lawyers partners. Just like in a medical practice, I don't think you would want a physician's son and daughter to doing medical checkups if they're not physicians, right, guys? So, is this bona fide? And the answer is no. It wouldn't meet the standard, and therefore it would be ignored. And dad should be taxable on all the income. He's doing the work, they're being paid for his services, he would be taxed. How about father's a lawyer who makes daughter a partner in his sole practice? Under Culbertson, would that work? And the answer is sure, right? Assuming the father really intends to work with his daughter, we're kosher with that. Question C, father owns the building and he transfers the building along with the lease to a partnership with his son and daughter. And now he's transferring a capital asset, and as long as he's transferring title and it's a capital asset and title is actually going into the partnership, that should work as well. Okay? If they're intending the three of them now to hold the property. Now, that doesn't, all that's saying is the partnership owns the property and they can split the rental income. The father, just so you know, has made a taxable gift to his son and daughter, but that's not an issue for us, okay? Issue for a different class. How about father owns a group of commercial rental properties which he transfers to a partnership with a son and daughter who provide no consideration, so it's a gift, for their 1/3 interest. Assume the partnership is respected for tax purposes. The income from the partnership is $90,000, okay? What results, so the income this building is gonna generate is $90,000. What results if father renders services worth $30,000 to the partnership, but the partnership agreement merely calls for splitting the income equally among the 3 partners, and each partner actually receives $30,000? Well, what do you guys think?
He's not really a partner.
Well, how would you tax this? How should this be taxed?
Because the 90,000 total.
Say again?
It should be taxed on the 90,000 total.
On all 90,000?
No.
Shouldn't the father be taxed, right? The dad be taxed on the 30,000 for the services he renders? How much does that leave?
60.
60. You then be divided 20, 20, 20, right? That's what it should be, and that's what the outcome would be under 704E, E1. So again, even if you tried a special allocation here under 704B, right, George, and you had C, theoretically substantial economic effect, it wouldn't work, because 704E would trump it. How about if father renders no services, but the agreement provides the income is to be divided 20% to dad and 40% to his son and daughter? Would that work? That allocation? The answer is no. In the context of the gift, right, it doesn't work, because again, he provided the capital. He's supposed to get under 704E1, he provided the capital. They're 1/3 partners. He should get 1/3 of the income, because he contributed the capital. So if you look at 704E1, if you make a capital contribution, you're supposed to get a fair return on what you put in. And if he remains a 1/3 partner, he should get 1/3 of the income. Question C, what if father renders services worth 30,000 and the agreement is the same as B above? Again, I think you're right back to A, where the father should be compensated for the $30,000, and since he contributed the property, he should get, and he's a 1/3 partner, he should get 1/3 of the remaining 60, right? Fine. He wouldn't get 20 because he's supposed to get, he's a 1/3 partner, right? And question C. Right, but it says same as part B, where he's supposed to be divided 20 and then 40 and 40, but again, code section 704E says you can't do a special allocation in that event because he's got to get a fair return, right? So he's got to get 1/3. Now between the son and the daughter, since they didn't make any gifts, they can divide the remaining income however they please, as long as there's substantial economic effect. But 704E says he must get his proportionate return based on his contribution, which means since he contributed the property, right, and he's a 1/3 partner, he remains as if he owned or retained 1/3 of the ownership of that property.
So you wouldn't take into consideration his compensation of the
I wouldn't take into it, no, that's separate and apart. One is his services, right, Renee? The other part pertains to the capital interest itself.
So it's better to reduce his guarantee payments and make him 1/3.
You know, I don't, first of all, George, I would stay away. I think you used the phraseology guarantee payment. I'm not sure if that's.
Yeah, the taxation is 30,000.
Well, let's stay away from that. I don't know if I want to say what's good or bad. Let's just talk about the tax effects, okay? It's very hard when you're given skeletal tax, and if you're talking with a taxpayer, you want to get a comprehensive look at what's going on. and we're not told enough. So let's just, given those facts, this is the outcome. Question D, what results if son renders $30,000 and the agreement is the same as A above? Okay? And in this case, who should be taxed on the 30,000?
Son. Is the father still
The son.
giving services also? Providing
No,
services?
I don't,
Is it only the son providing services here?
I mean, that's where you get into a little bit of a problem, who's providing the services. If son, I think it's the saying, the son renders the services worth 30,000, and then they're gonna split the profits. Again, the son, in accordance with that regulation, should be paid for whatever the service is rendered, and whatever is the balance, because the services, they can agree to split any way they wish, okay? So I'm okay with the son being taxed on 30, okay, and then the remaining 60 being split 20, 20, 20, or however else they want to split it. But he should be taxed on his 30. And does it make a difference if the son and daughter purchase their 1/2 interest or 1/3 interest from dad for fair market value? If you look at the code section 704E2, 704E2, it says, treat that purchase as if it were a gift. Okay? So you can't avoid these rules. You can't circumvent these rules by going through the purchase route. Okay? Can't avoid these rules by going through the purchase route.
Just to be clear, you're saying like the father gave them the money to buy the.
Not if they gave, even if they use their own money. Doesn't matter. The word purchase does not negate the application of 7048. Yes. Can you, I might use your phrase, Alex, just say again, what about, you're talking about the basis, right? Well, whatever, I'm not sure what your question is. I don't know what the father is gifting, they're purchasing, right? Remember, if they purchase, their outside basis is equal to the cost, right? And what we'll see is generally a purchase of a partnership interest does not change the inside basis unless there's something called a 754 election, which we'll talk about after the exam, all right? So hold that thought. Right now, that's not for our purposes, okay? All right, one more section, and then we'll take a break, guys. So this does not come up too often, okay? This meaning partnership, you know, generally 704E is just to stop taxpayers, family members from running roughshod, right? And doing things to assign income to lower income tax rates. And keep in mind, when we were talking before about minor children, I believe under the new rules, and you guys can correct me, I haven't, the under income, is it effective for children under the age of 18 or 21? Help me on that. Where it's taxed at the trust and estate tax rate. Does anyone know? No one knows. All right, I'll have to check that out. But the point is, if you have adult children, right, there's still an opportunity to try to avail, families to try to avail the lower tax rate. So Code Section 704E is designed to put the brakes on. Page 192, allocations where partners' interests vary during the year, right? Partners' interests may vary over the year, correct? Correct.
I think it's 18.
Is it 18? Okay, that makes sense. But if you want, take a look at Code Section 706D. Code Section 706D. talks about determination of distributed share when a partner's interest changes. Essentially, the Treasury regulations say that if you don't do anything, this is spelled out on page 193, the paragraph that goes from 193 to 194, that the default method is the so-called interim closing of the books method. So if a partnership interest varies during the course of the year, and we'll see some problems on this, you treat as each partner changes his or her interest as if the books are closed. Okay? Artificially, you treat it as if the partnership closed its books, and you determine each partner's interest in a proportionate way. But you can elect, so plan B, if you don't do the interim closing of the books method, is a pro rata method. You treat, no matter what happens during the course of the year, you treat every day as if it's pro rata, that it gets a pro rata amount of the income or the losses. So again, the default method, close the books. You can elect the pro rata method. And the interim method is spelled out on page 194. First paragraph treats each segment of the taxable year as if it were a separate distributive share period. And on top of page 195, the pro rata method, you prorate the partnership items throughout the year. That's a little bit easier than the interim method, but again, depending on who you represent, can cause very different outcomes.
So it's like S corps.
It's like S corps. True. All right, exceptions. There are some exceptions. That service partnerships have a lot more flexibility. They can use any method they want, but so-called extraordinary items, and we'll see an example of this on page 196, they talk about extraordinary items. With respect to extraordinary items, you may not have a choice. They often are placed on a pro rata method. So certain extraordinary items, excuse me, I may have misspoken, they're going to be placed on the interim method. Okay? We'll see how this plays out. Okay? So there's sometimes you don't have a choice. This is not as complicated as some of the other things we've looked at. Look at page 197, and let's just get through this problem before the break. We have ABC partnership has 3 partners, each who has an equal interest in the partnership, capital profits and losses. C contributed to pay off expenses. C contributed on October 31st, which if I hold up my fingers, that's Halloween. That's at the end of the 10th month, right? Leaving only 2 more months, November and December, right? So 10/12 have passed, right? As a result of C's contribution, the interests are going to go from 1/3 to 25%, 25%, and 50%. The partnership I have underlined is an accrual method calendar year taxpayer. If the partnership loses $24,000 and the partners use the proration method, how will the losses be allocated? So if they use the proration method, how are you going to allocate that under Code Section 706D? You have a partner, A and B, and then you have partner C. What's their profit and losses? For part of the year, it's 33%, 33 and a third. And for part of the year, it's 25%, right? And for C, it's also 33 and a third, and it's 50%, right? How many months? 10 months, 2 months, 10 months, 2 months, right? So we know the losses here are 24,000. So the computation, right, is 10/12 times 1/3 times 24, 2/12 times 1/4 times 1/2 times 24 and this is 667, this is 1,000. So A and B each command 7,667. C commands a loss of 8,667. If you do the arithmetic, it will add up to $24,000, which it should. Everyone agree? So nothing fancy here. You just have to figure out each one's interest rate. And it's just presumed under the proration method, right? You got elected. And it happens this 24,000 loss equally throughout the year. Each month there is essentially a $2,000 loss, right? Everyone agree? That's it.
That's the third, being the third is after
No, that's at the beginning of the year. That's January through October. They're each a 1/3 part. Okay? Question B. What results if the facts are the same as in A, except the entire $24,000 loss was incurred the first half of the year, but the expenses that created the loss were paid on November 15th with cash contributed by C. Remember, it's an accrual method taxpayer, right? All the other income and deductions of the partnership accrued ratably throughout the year, and the partnership uses the interim closing of the books method. So now we're going in the interim closing of the books method, right? When does that happen, the interim closing of the books method, guys? It happens, say again, Viva? No. That's just an arbitrary date when it was paid.
June 30th.
Whenever they accrued the deduction, right? When does it say the deduction was incurred?
First half.
First half. So how are you going to divvy up these $24,000 of expenses?
Well,
Say again, George? So how would you divvy up the $24,000 of losses? So on taxpayer A, B, and C, how are we going to divide that up? Say again, Ramon? 1/3 for each, right? $8,000 deduction, okay? Everyone agree? Be an $8,000 deduction for each. Then you good? Notice the difference between the pro rata method versus the interim closing the book method. We know when the loss happened, they were each 1/3 equal partners, right? So they each, at that point, should be entitled to that deduction. Agreed? So your notes for question B, instead of A and B getting this and C getting this, will be 8,000, 8,000, 8,000. Okay? You got that for your notes? Question C. Assume all the facts are the same in A, except that the partnership now, instead of being an accrual method, is a cash method taxpayer. The partnership uses the interim closing of the books method, and all the income and deduction items, other than the $24,000 loss, were received or incurred ratably throughout the year. What result if the loss is the result of a payment on November 15th of $24,000 to rent an office for the entire year? Now, remember, this happened now during November, and it's cash method. So should C get 50% and A and B 25% each, guys? Yes or no?
Yeah, yes,
Yes?
yes.
Okay, but look at 706 D2B. 706 D2B. 706 T2B. Certain items, including, okay, even if you're on the cash method, and remember, this is for rent for the entire year. That rent payment has to be treated as if it accrued ratably. Okay, guys? Has to be included as if it were ratably. So what that means is you can't do this. That it would be treated as if it's the same answer as an A, because this, you can't pretend that this rental payment, it's too much gamesmanship, Ramon. So 706, like I said, in the regulation 706 D2B would force this to be essentially on the accrual method.
Professor Solis?
So that's 3 little I, payments for the use of property. Yes.
If the rent was paid for on November 15th, how is it for the same calendar year?
I don't know what you mean by that.
I mean, if the rent was paid on November 15th, 2019, how does that work for January 1st, 2019 to December 31st, 2019? You know?
Yeah, just, I mean, I don't, obviously, I think the author's having some fun.
Okay.
Most people are not gonna do that, right? They're gonna demand to be paid before the year begins.
Right.
But we're gonna suspend, and pedagogically, they're asking what would happen. And what the author's point is, given this exception, you gotta treat it as if it happened ratably. So for your notes, same as an A. Partnership breaks even for the year, but the loss is the result of a settlement of a breach of a contract suit brought by plaintiff. Settlement is made June 1st, and the payment is made November 15th. So the question is, in this case, does it fall within the scope of one of those exceptions? And the answer is no, it does not. It's not there. So in this case, since it's cash method taxpayer being made in November, it would end up, right, Renee, 25%, 25%, and 50%, right? Because we're on the interim closing of the books. Everybody got that for their notes? So in this case, it would be 6, 6, and 12. 6 and 6 to A and B, 12 to C. Right, guys? Just say it loudly, Renee. People are going to get mad at you, not me, because they're going to be on WebEx saying, what was she saying? I'm trying to help you guys on WebEx.
I thought I remember reading in one of the regulations that, this type of settlement is an extraordinary item.
but as in even, this is not one of the items listed. This is not one of those items that are listed. You can check me on that. It would not be. And finally, 3 little I. The loss on 1 little I occurred is the result of a payment on March 1st of the current year of $24,000 of rent due from the prior year. Okay? And what does it say? That in this case, again, it's going to be treated as an extraordinary item, and it's going to be pro rata, and they have to do it $8,000 a piece. As if it, because it happened, it would be whatever was, excuse me, it would date back to the beginning of the year, whatever their ownership interest was as of January 1st. I apologize, but it was January 1st, 706 D2A. 706 D2A. Final question, and then we'll take a break, guys. We have ABC Partnership, 75% partner in ABC Partnership, in which C owns the other 25%. Both partners use the calendar year as their taxable year. The ABC Partnership has a loss of $16,000 for the year. D decides to become a 1/3 partner in the AB Partnership on December 1st, towards the very end of the year. Presumably, he wants to share in that loss by making a cash contribution. Okay, so just get the visual on this, is that we have a partnership here, right? It's got a $16,000 loss. This is a tiered partnership. Taxpayer C owns 25%, and it's tiered, right? Because the AB partnership owns the 75% interest, and you have partners A, B, and now D. Okay, it's a tiered partnership. This is the lower tier, right? The lower tier partnership. This is A, B, and C partnership, right? A, B, C partnership, right? Lower tier, and then we have an upper tier. And the question is, and D comes in, and if you have the interim closing the books method, and the loss is $16,000, you could say $12,000 of the loss is going to be allocated to this partnership, right? Do the arithmetic. $12,000 is going to be allocated to the AB partnership. And D would like to come in and command a 1/3 of that loss, because 12,000, right? Going to be allocated 12,000 loss here, 4,000 loss here. And D would like to get a proportionate share of that, 1/3 of that loss. But if you look at the tiered rules, this is under 706 D3. 706 D3 says no, you can't do that. You got to use essentially the pro rata method, where, let's do it together. A had a 1/2 interest times 11/12 times 12,000, 5,500, and he had a 1/3 interest, right? Times 1/12 times 12,000. So his loss is going to be $5,833. $5,833. And D, who came in last minute, as a 1/3 partner, he can only get 1/3 of 1/12 of 12. He can only get $333. So A and B each get $5,833. D's gonna get this, and together, their total loss, right, is gonna be $12,000. Good news, guys. If you think this was fun, partnership liabilities in the next chapter is even more fun. So let's keep our break to 9 minutes. I will see everyone here at 5 of 8, okay?